We've now reached the third step in the lease accounting process. At this point, we've determined that a contract contains a lease and we've separated the lease and non-lease components. The next step is to classify each lease component. And under ASC 842, a lessee will classify a lease as either an operating lease or a finance lease. Classification for lessors works a little differently, but since we're focused on lessees in this series, our leases will fall into one of those two categories. And because classification applies at the lease component level, it's possible for a single contract to contain multiple lease components with different classifications. The accounting does differ between operating and finance leases, so it's important that we classify them correctly. The classification process itself is straightforward. ASC 842 uses a 5 criteria test to classify a lease. We'll walk through each of them, but the key idea is simple. If the lease meets any of the 5 criteria, the lease is a finance lease. Otherwise, it's an operating lease. Now, before we discuss the 5 criteria, there's an important term in the standard we need to define, and that's the lease commencement date. ASC 842 tells us that the classification assessment is made at commencement, and this is also the date we'll use when we record the opening journal entry for the lease. So understanding exactly what commencement means is important. So what is the commencement date of a lease? ASC 842 defines it as the date the lessor makes the underlying asset available for the lessee to use. From an accounting perspective, this is the key date, not the date the contract is signed, and not necessarily the date we start using the asset. If we lease a building and the lessor hands us the keys on January 1st, the asset is available for use on that date, even if we don't move in for several months. That availability is what establishes the commencement date, and it's the date we use for both the classification assessment and the opening journal entry. Now let's return to the classification criteria. Remember, we have 5 questions we need to answer, and a single yes means the lease is a finance lease. And the first question is straightforward. Does the lease transfer ownership of the underlying asset to the lessee at the end of the lease term? For example, we might need a piece of specialized equipment and arrange for a lessor to build it and lease it to us for 10 years, with ownership transferring to us at the end of the lease. In that situation, the lease meets this first criterion, and it would be classified as a finance lease. The second question is very similar. Does the lease include a purchase option that the lessee is reasonably certain to exercise? This one requires more judgment from management, but if we have the option to buy the asset and we're reasonably certain we'll exercise it, then the lease is a finance lease. A common example is a vehicle lease. Many vehicle leases include an option to buy the car at the end of the term, and if we're reasonably certain to exercise that option, we would classify the lease as a finance lease. This is also an area where judgment becomes especially important, because the term reasonably certain plays a major role in lease classification. This is a relatively high threshold, in practice higher than the more likely than not threshold we sometimes see elsewhere in US GAAP. ASC 842 doesn't define the term reasonably certain outright, but it does provide helpful guidance in the implementation section. We'll look at that now because this idea of being reasonably certain to exercise an option shows up in several areas of lease accounting, not just classification, but also when we evaluate other options that may be included in a lease, like renewal periods or termination options. So in paragraph 842.105526, the standard explains that an entity assesses whether the lessee is reasonably certain to exercise or not exercise an option by considering all of the economic factors that are relevant to the assessment. And it lists 4 different economic factors to consider: contract-based factors, asset-based factors, market-based factors, and entity-based factors. And the guidance makes it clear that these decisions are often based on a combination of these. The underlying idea is that a lessee is reasonably certain to exercise an option when it has a compelling economic reason to do so. It's not enough for management to say, yes, we think we'll exercise that option. The assessment must have economic substance and must be based on economic factors. The paragraph also provides some examples of the types of factors to consider. First, when we look at contract-based factors, we're really looking at what the lease agreement itself tells us about the economics of exercising an option. That could include comparing lease payments in an optional period to current market rates, the amount and structure of any variable payments, termination penalties, or residual value guarantees. And we'll look at all of those items as we move forward in the series. We may also look at other option-related terms. For example, a lease might include a clause that if the lessee renews for one more year, we're then able to purchase the asset at a price well below market value. That kind of built-in benefit creates a strong economic incentive to exercise the option. Next, we'll look at asset-based factors. These relate to characteristics of the underlying asset itself. The most common example, one that ASC 842 specifically highlights, is significant leasehold improvements made by the lessee. If we've invested heavily in customizing or building out the space or equipment to suit our operations, we now have a strong economic incentive to continue using that asset. And it becomes far more likely that we would exercise a renewal or purchase option. Other asset-based considerations can include how specialized the asset is and whether it could realistically be replaced without disrupting our operations. Next are the market-based factors. These look at economic conditions outside the contract itself. One example the guidance highlights is the cost the lessee would incur to move away from the asset. That could include relocation costs, legal fees to negotiate a new arrangement, or even the cost to return the asset to a required location. In some cases, those costs may be high enough that renewing the lease becomes the economically favorable choice. So even though nothing in the contract forces the lessee to renew, the surrounding market conditions can create a strong incentive to do so. The last category is the entity-based factors. And these are really about how important the asset is to the business. Maybe the asset is critical to operations, or it's highly specialized and not something we can replace easily. In those cases, even if the contract or the market doesn't strongly push us toward renewing or purchasing, the needs of the business itself can create a strong economic incentive to exercise an option. So part of this assessment is simply looking at how essential the asset is to our business. And as the standard points out, in most cases we'll need to look at a combination of these factors rather than relying on just one. Contract terms, the nature of the asset, market conditions, and the needs of the business often all interact with each other. So when we're evaluating whether an option is reasonably certain to be exercised, the goal is to look at the full picture and determine whether, taken together, those economics create a strong incentive for the lessee to exercise the option. I know that was a deep dive into this idea of being reasonably certain, but it's an important concept and one we'll come back to in multiple steps of the lease accounting process. So now that we've covered how to think about renewal, termination, or purchase options, let's bring this back to where we started. This entire discussion came from the second criterion in our lease classification test. Does the lease include a purchase option that we are reasonably certain to exercise? If the answer is yes, we have a finance lease. If not, we move on to the remaining 3 criteria. We'll walk through each of those in the next episode.